I need you to focus completely. Close every other tab on your browser right now, including the incognito one. We'll assume you're just researching sensitive investment strategies. I'm John AG from Currency Archive. The price your broker shows for COMEX spot silver is a lie. It's a fiction, a number generated by a computer in New York that has lost touch with physical reality. While your screen says $85 per ounce, the real price in Shanghai, China today is $93.31. Let that sink in. $93.31. That was the closing price for the afternoon session on the Shanghai Futures Exchange today, January 12, 2026. The spread between the fantasy in New York and the reality in Shanghai is now $8.31 per ounce. In a functioning market, this gap wouldn't last 5 minutes. Arbitrage traders would buy in New York at $85, ship it to Shanghai, and sell at $93 for a risk-free $8 profit, closing the gap within hours. But the gap isn't closing, it's widening. The reason is the single most important thing to understand. The arbitrage is dead. The bridge between East and West has been blown up. The metal that once flowed freely is no longer moving because there is no metal left to move. This is the day we warned about, the day the paper market dies. You are watching the system break in real time. Let me walk you through today's insane numbers. The Shanghai Futures Exchange trades silver in morning, AM, and afternoon, PM, sessions. The AM sessions closed at $91.13 per ounce, already a massive premium over the US. Then the PM session opened. The buying pressure was overwhelming. Industrial buyers, corporate procurement, strategic orders sweeping the order book at any price. The sessions closed at $93.31. A $2.18 move in one afternoon. That's the kind of move you see in a currency crisis or a bond market collapse, not a physical metal. It signals desperate buyers. Meanwhile, in the United States, the COMEX spot price here quoted on every news channel and broker platform closed around $85. The US market is trading at least $8 below China. That's not a premium, it's a chasm. An $8 spread on a fungible asset like silver is a market failure. It means the two markets are no longer connected. Price discovery has broken down. We are now trading in two separate markets with no relationship. The most terrifying part? The gap is expanding, not narrowing. 2 weeks ago, it was $5. Last week, $7. Today, $8.31. This tells you pressure is building, not releasing. Chinese buyers are willing to pay more each day above the Western price, front-running the inevitable breakdown. Why pay $93 when spot is $85? Because the spot price is irrelevant to it's the price of a paper promise for metal that may or may not deliver in 3 months. The Shanghai price is for real, touchable bars you can truck to a factory. In a world of empty vaults and delivery failures, the physical price is the only one that matters. Silver at $93 in China isn't a rally, it's a repricing. The market is finally discovering the true value of scarce physical metal. So why can't arbitrage traders close the gap? Why aren't banks buying in New York and selling in Shanghai? The answer is simple and terrifying. There is no silver to move. Arbitrage requires price divergence. We have that. And available supply. That's where the system breaks. When banks try to buy physical silver in New York is standing for COMEX delivery, sourcing bars from dealers, pulling from vaults so they find the metal isn't there. COMEX registered inventory is down to about 30 million ounces. That sounds like a lot until you see the open interest paper claims representing hundreds of millions of ounces. The metal backing those claims doesn't exist. It was drained months ago by the smart money. Even if a bank found silver in New York, they can't ship it to China due to the new export licensing system. Metal that enters China is trapped, it doesn't come back out. China has created a one-way valve. The arbitrage isn't just difficult, it's impossible. The bridge is destroyed. The two markets are now completely disconnected. This is the bifurcation we discussed, and today it became undeniable. You might think, so China pays a premium. Why does it affect me? Because what happens in China today is a preview for the United States tomorrow. The Chinese market is the canary in the coal mine, and the canary just died. When Chinese buyers pay $93 against a paper price of $85, it tells you the paper market is mispriced by $8. Eventually, the paper market must correct to reality. It catches up through a delivery squeeze, a default, a force majeure declaration, of mechanisms that all lead to the same outcome. The paper price explodes upward to meet the physical price. When COMEX admits it can't deliver, the US price won't drift from $85 to $93, it will gap overnight to $95 or $100. Once the paper illusion shatters, The real price is whatever desperate buyers will pay. Shanghai's price isn't a foreign anomaly, it's a prophecy. It shows where the US price is headed and gives you a narrow window to prepare. But Shanghai is just one piece. While watching China go vertical, I called contacts in the US physical silver industry. What they told me should terrify you. I spoke to executives at major US bullion dealers, the largest suppliers to the retail market. They told me point blank, nobody has any silver. Premiums over spot exploded today. Last week's $5 premiums are now $8, $9, and that's just the starting point. One executive said, quoting directly, silver round premiums could go to $20 to $30 per ounce here. That puts the real cost at $105, $115. He wasn't speculating, he was looking at inventory sheets and order backlogs. The private mints producing rounds and bars are overwhelmed. Orders in the last 2 weeks exceed the 2020 squeeze. Back then, they ramped production and caught up. Now, they can't get raw material. Refineries prioritize industrial users like Tesla, Apple, and solar panel manufacturers. Mints are at the back of the line. Delays are exploding. If you order a silver round today, expect an 8-week wait to 2 months, assuming the mint doesn't run out and refund your order. You have two bad options: buy from a dealer with inventory at an insane premium, or place an order with a mint and gamble for 8 weeks that the system holds and they can source silver. If you want silver, you must pay the premium. The spot price is a fantasy. The real price is already pushing $100. This reveals an uncomfortable truth. The price on TV isn't for silver, it's for a derivative via a futures contract, an ETF share, a paper promise. When you try to convert that promise to metal, you find the conversion rate isn't 1-to-1. Paper says $85, metal costs $100. This paper to physical premium is exploding. Why? Dealers aren't stupid. They see Shanghai's price, delivery failures, and COMEX inventory drain. They are pricing in the future. They know the silver in their vault today will be worth much more next month. So why sell it cheap? They're rationing inventory, waiting for the spot price to catch up to physical reality. When it does, these dealers will make a fortune selling at $120 or $150. Investors who waited, believing the spot price and hoping for a dip to $75, will be left with nothing. The metal will be gone. This supply shock is here today, not next month or year. Now, let's zoom out. The silver squeeze isn't isolated. Gold hit an all-time high today, somewhere north of $4,600 per ounce. That's a massive breakout. When gold and silver rip to record highs simultaneously, it's not a coincidence or a commodity rally. It's a signal of the market voting with billions that the fiat currency system is failing. Most people miss this. When gold and silver go vertical, they create a liquidity black hole. The global financial system is built on risk-free assets like US Treasury bonds. Their interest rate is used to value everything else's stocks, corporate bonds, real estate. But when gold gains 30% and silver 170% in a year while treasuries lose money, the model breaks. Investors ask, why hold 4% treasuries that lose value when gold gains 30%? They sell treasuries for hard assets. Treasury prices fall, yields rise. Rising yields mean higher borrowing costs, causing companies and consumers to cut spending, slowing the economy. Crucially, stock valuation models break. Stocks are valued by discounting future earnings using the risk-free rate. If that rate rises, the present value of earnings falls. So even with steady profits, stock prices must drop. This is why surging gold and silver are so dangerous for stocks. It's about the entire valuation framework collapsing. We've seen this set up 3 times recently: 2000, dot-com crash, 2007, housing bubble burst, and 2019, repo crisis leading to COVID crash. Now, in 2026, the signals are back: gold, silver at all-time highs, treasuries under pressure, and a trapped Federal Reserve. Which brings us to the elephant in the room, Jerome Powell. News broke of a criminal probe into the Fed chairman over concerns about Fed independence and conflicts of interest. I won't speculate on details, but the timing is not a coincidence. The Fed is losing credibility as markets fall apart. When confidence in the central bank evaporates, bad things happen fast. The Fed is trapped with 2 disastrous choices. Choice 1, print money, lower rates, restart to inject liquidity. This saves stocks short-term but destroys the currency, sends inflation spiraling, and makes gold, silver soar. If they choose this, silver doesn't stop at $100, it goes to $150, $200, or higher. Choice 2, don't print, hold rates high, let bad debts fail, companies bankrupt, housing crash. This restores discipline but causes a depression. Stocks crash, unemployment soars, credit freezes, banks fail. Silver might dip short-term in deflationary panic, but will surge long-term as the system loses all credibility and people flee to hard assets. The Fed can't print without destroying the currency. It can't not print without destroying the economy. The market sees Powell under investigation, sees the Fed losing control, and is voting with its feet exiting the dollar and treasuries for gold and silver. This confidence crisis is accelerating. The Fed's trap directly impacts silver. If they print, silver goes vertical from currency debasement. If they don't, silver goes vertical from a flight to safety amid industrial shortage. Either way, silver wins. That's why it's the most asymmetric trade now. You're not betting on one outcome, but a range where all paths lead higher. The only scenario for silver to fall is if the Fed perfectly threads the needle and new mines flood the market to odds near zero. The risk-reward is massively skewed, maybe 10 to 15% downside, 100% plus upside. But the window to act is closing fast. 2 weeks ago, silver was $75. Last week, $80 with a small premium. Today, it's $85 spot plus and $8.9 premium. So all in at $93, $94. Next week, the premium might be $15. The week after, dealers may be sold out. This is the escalator effect. Every hesitation moves you up another step. The perfect entry was $20 2 years ago. The good entry was $30 6 months ago. The acceptable entry was $75 2 weeks ago. Today at $93, $94 all in is still reasonable if you believe the thesis, but it's deteriorating daily. You must ask, do I believe silver is going to $150 or $200? If yes, then $94 today is a 50% discount to that future. Hesitate, and you'll watch silver hit $200, thinking, I should have bought at $94. Don't be that person. Decide now. Now, the buying mechanics. The strategy from 6 months ago no longer works. Back then, buying an ETF like SLV seemed safe to attract price and was liquid. Today, SLV is a gamble. It's backed by physical silver held by JP Morgan. We don't know if that silver actually exists. JP Morgan has a private hoard of 750 million ounces. But is it backing the ETF? SLV's prospectus allows cash settlement in a market disruption. If COMEX breaks and vaults are empty, SLV can give you cash instead of silver. Cash is useless if silver is $150 and you get $85. SLV is a risk I don't recommend. A safer option is PSLV, the Spread Physical Silver Trust, domiciled in Canada, storing silver at the Royal Canadian Mint. It allows physical redemption for large positions and has more transparent auditing. It's not perfect, but better than SLV. The best option is physical silver in your possession of coins, bars, rounds in a home safe or private vault you control. Yes, you pay a premium and deal with storage, but you actually own the asset. In a failing paper market, ownership is everything. Buy physical today. Pay the premium. Handle the inconvenience here. It will save you from catastrophe tomorrow. If you can't afford physical, at least buy PSLV over SLV. Give yourself a fighting chance. But don't sit in cash, treasuries, or money market funds earning 4% while the world burns. Shanghai's $93.31 price is a warning. The paper market is dying. The physical market is all that matters. The gap will widen until the paper market breaks completely. My timeline, based on data, Shanghai premiums, and dealer inventories. I believe we have weeks. January delivery notices will be released soon. A spike in demand, a contract standing for deliverable will trigger a panic. The market will realize COMEX doesn't have the metal. Once that realization hits, the price will gap up violently. $10, $15 in a single session. Silver could open at $100 on a Tuesday because something broke over the weekend. When that happens, physical premiums will explode further. $20, $30 over spot. Mints will stop orders. The retail market will shut down. If you don't have silver by then, you won't get it. You'll watch prices hit $150, $200, knowing you could have bought at $94. The time to act is now, not tomorrow. This is your Lehman Brothers moment. But it's a commodity market collapsing. The Fed can't save it by printing dollars because you can't print silver. Shanghai's $93.31 is the smoking gun, a proof the system is broken. Arbitrage is dead, and markets have split into separate realities. The Western market lives in fantasy, the Eastern market lives in reality. Reality always wins. Get out of the fantasy. Exit the paper market, the ETFs that might not deliver, the futures that may cash settle. Get into the roller, the physical metal you can hold. When this system breaks, and it's breaking now, physical silver owners will be the winners, paper promise holders will be the losers. The choice is yours. The clock is ticking. Shanghai, $93.31. US, $85. The gap is $8 and widening. How much wider before you admit the paper price is a lie? This is John A.G. from Currency Archive. Remember to like, subscribe, and share. Get your money out, get your silver in.